Hello, everyone. Welcome back. And today we're going to be talking about one of the simplest risk management tools that we can use as portfolio managers. It's so simple, it'll feel like it's almost too good to be true, but it really is not too good to be true. So let's take a look at that. And I think this is worth looking into a little bit further. I'm Mayur Thaker. I am an analyst and co-portfolio manager here at Zacks Professional Services. So let's get started. So as investors, just a quick, broad background, right? We all are investors, either institutional or individual, but we must continuously weigh two primary factors that affect what we do on a day-to-day basis. One is fundamentals. Understanding the direction of the economy, understanding the direction of revenue of companies, understanding the direction of earnings, and all the factors that affect all of the above. That's what we call, broadly speaking, fundamental analysis. But we also must factor in and consider price. Because remember, price can move in any direction, up or down, regardless of our assessment of fundamentals. And so we must pay attention to both. We have to pay attention to both. And so this risk management tool that I'm about to present here has to do with category number two, price. So what we have to do as analysts, as portfolio managers, as investors, we should always spend most of our time developing a fundamental view of the direction of earnings and valuation. But we must always respect the primary trend in price levels. So spend our time doing the deep dive work on the fundamentals of the companies that we own, or the fundamentals of the broader macroeconomy if we are index investors. We have to develop a fundamental view of the direction in which things are moving, and also develop a view of valuation. Are markets overvalued or undervalued or fairly valued? So that's where we spend the majority of our time, but we also must always respect the primary trend in prices. So it's that second portion that I'm going to be addressing here today. How do we understand the primary trend in price levels for any security, be it individual stocks or the broad market? So why should we do that, right? Why do we have to respect the primary trend in price? Because our fundamental analysis could be wrong. So remember, even the greatest investors have been wrong quite frequently. Warren Buffett himself has said that, my entire investment career could be summarized down to about 8 great trades, 8 decisions that he's made in his entire 50-year career or 60-year career that, explain 99% of the returns that he's generated for Berkshire shareholders. So just 8 great trades, which means that, the vast majority of his other trades have not been great, or has not contributed significantly to the billions in wealth that he has created for shareholders. So our fundamental analysis can and will be wrong, right? It's going to be wrong. If you've been in the business long enough, you will make more than a few bad calls in your career, and that's okay. So we must respect the primary trend because of this very reason that our fundamental analysis could be wrong. The case in point, for example, in the most recent period is Cathie Wood. She is the Chief Investment Officer at ARK Investments. And, she could be right in terms of her fundamental analysis, right? She could be right in terms of the companies that she has picked that will ultimately, grow into, great companies in the future. But if we ignore the price trend, then that, eliminates the risk management that needs to come with our fundamental analysis, right? Because there's always two sides of the coin. There's fundamental direction of earnings and revenue of the companies that we invest in, but then there's also valuation. So if the valuation has reached nosebleed levels, then even if you're right about the direction of revenue and earnings, your performance could actually be very, very poor or mediocre. So we have to weigh both. We have to weigh both the fundamentals, and we need to weigh the price action in the securities that we own. So let's take a look at that. Let's understand exactly what I'm going to be, here's my proposal. And it's going to be extremely simple. So here, I'm going to dive into ZRS World. And I'm going to go over here to charts. I have the S&P in here. So we're just going to take a look at the SPX as our key, example that we take. And I'm going to go over here to charts and technicals. And I'm going to click on technical indicators and overlays. So here is a simple chart of the S&P 500 over time. This is just over a couple of years here. Let's go back to the max history. So this takes us all the way back to 1994. So here we have, a very simple chart of the S&P 500 over that entire time period. And what I'm going to overlay here is I'm going to go down to options and we'll click on overlays. And I'm going to select this exponential moving average. And I'm going to enter in 10 over here. Now, what this is going to do, I'll click update and that will add that. So what this is a 10-month moving average of the S&P 500 over time. This is a monthly chart, by the way. So when I enter 10 in here, it refers to 10 months. If I were to, reduce it to say, a 5-year chart, the way that the system works is that anything 5 years and less, it switches to a weekly frequency. So the 10, periods here now refers to 10-week moving average. But we want, a much bigger, broader, big picture understanding of the primary trend. So if I go to the max here, anything beyond, 10 years switches over to a monthly frequency. Anything under 10 years switches to a weekly frequency, and I believe anything under 5 years switches to a daily frequency. So I'm going to go back to the full max history, and that goes to a monthly frequency. And so the 10-period moving average that I have here is going to refer to the 10-month moving average. So all I'm saying here's the simplest risk management rule that we can follow. Buy the S&P 500 every time it's above its 10-month moving average. Okay, so as long as the S&P is above the 10-month moving average, on the monthly close, if the monthly close is above the 10-month moving average at that monthly closing period, then be long the market. And upon a monthly close below the 10-month moving average, like we see over here, we would sell the market and be in cash or in money market securities. Very, very simple. So if we simply did this, you can see how effective this would have been. Now, there's been a couple of periods, just a few periods where you did get whiplashed, right? For example, this was the collapse of long-term capital management. I believe that was over here in 1998. I could be mistaken about that, but I think that was right around that period here. And the markets all took a big dive. It was just a quick flash crash. But then the market recovered, so obviously that would have been a bad trade. But look what happens eventually. That, once this broke over here, right around the year 2000, the market never regained that 10-month moving average. This entire drawdown for years. Until in 2003, when it finally regained the 10-month moving average, I should say. And then it was along this entire time period. As you can see here, it remained above the 10-month moving average, throughout the rest of 2003, all of 2004, all of 2005, all of 2006. And then halfway through 2007 is when it broke that 10-month moving average. And then you would have been out of the market, for half of 2007, all of 2008, and half of 2009. So then you would have bought back in upon that next bullish crossover above the 10-month moving average, which happened in I believe it was June or July of 2009. So as you can see here, you avoided one of the biggest drawdowns in modern, market history. You would have also avoided this massive bear market that we saw as, the dot-com bubble burst. So these are two massive drawdowns that you would have avoided if you follow the simple rule. Now, let's see what's happened in the post period, post 2008. It's had a couple of bad calls here. So as you can see, it dropped below. So you would have sold out, but then you would have bought right back in. You would have sold out, bought back in, sold out here, bought back in. So it did generate a little bit of trading here. But as I would say, that is simply the cost of doing business, right? If you can avoid two major bear markets, over the past 20 years, then this is simply the cost of doing business, right? And as you can see here, you would have sold out here, avoided that bigger drawdown. So the best thing, the worst case scenario here is that you sell and then buy back at a very similar price anyway. So it's not like you're missing out on, a big upside by selling out and then buying back a month or two later, as you can see here. You would have sold right here during, the COVID, crash when, the market dropped below its moving average in February of 2020. And then you would have bought right back, upon the next bullish crossover, which happened in May of 2020. So yeah, would you have bought back higher? Yes, but it's not that much bigger. And remember, this is in order to avoid a much bigger drawdown, which none of us could have ever known, while all that was unfolding. So all this does is help us avoid big drawdowns and extended bear markets. Because remember, we just don't know, right? We don't know how bad things will get. And so if we respect the primary trend as defined as being above or below the 10-month moving average, then that can help us avoid a lot of additional pain. You can see how it's done in the recent past here. Just in 2022, the market dropped below its 10-month moving average right here in April of 2022 at a price of 41.31 on the S&P 500, right? And it's been in a bear market ever since, and it just now crossed over earlier this year, back in, March of 2023. It was March of 2023, exactly, yep. So as you can see there, you would have bought back in as of March of 2023, and you would be long ever since. So again, even if you got whiplashed a little bit here, remember you sold out at 4,100, let's say, in early 2022, and bought back in March at roughly the same price, so no harm done. So you would have bought and sold at roughly the same price, and you would have avoided this bigger volatility that the market went through late last year. So let's put this into numbers. So I went back and crunched the numbers, right? And here is exactly what would have happened if you follow this strategy over this entire 30-year period. So I have this in Excel, and if you'd like a copy of this Excel sheet, I'd be happy to send this to you. Here are all of my calculations. Here is the monthly S&P closing price, and you can see the monthly returns here. And then here is the 10-month moving average period. And so here I have calculated, the exact difference between just if you were to buy and hold a $1 million portfolio, in June of 1994, and just allow it to compound over time. What would your returns have been versus if you were to trade the S&P based on this monthly moving average crossover, this 10-month moving average crossover? And this would have been on point-in-time data. So this does not fall into any of the pitfalls of look-ahead bias or any of those other biases, right? This is actionable, data, point in time that you could have and would have acted upon if you were following this strategy, strictly. And check out the returns. This is absolutely mind-blowing. Now, you would have underperformed, as you can see here, in the early part of the 1990s, right? Because you would have sold out a little bit earlier here, and you got whiplashed a few times. So you would have underperformed a little bit, just a little bit, in the early 1990s. But then look what happened here. As the bear market of the 2000s began, look at that. Your returns basically flatline because you're basically in cash. As long as the market is trading below the 10-month moving average, you're just sitting in cash, and therefore your portfolio value doesn't really go up or down. It doesn't go up or down at all. In reality, though, your account would be going up because the idea is that you would switch over to a money market mutual fund, every time the market is below that 10-month moving average. So technically, this number would be going up slightly over time. And then as soon as it crosses over that 10-month moving average, you're back in the market, and now you're compounding along with the market. And then here again in 2007, the market dropped below its 10-month moving average, and therefore you flatline in your portfolio. You avoid this entire drawdown. And then as the market recaptures its 10-month moving average, you start to compound along with the market. And here that entire, compounding takes place all throughout the 2010s in the big bull market that we went through here. Saw a couple of ups and downs here. And then you would have been a part of that entire surge, post-COVID 2020, 2021. You would have, avoided this larger drawdown as we saw in 2022. And now you're back in 2023. So look at the difference that you see here. This $1 million portfolio would compound up to almost an $18 million portfolio over the past 30 years. Versus the market, if you were to buy and hold, compounded from 1 million to about 10 million. So it's a 10x in about 30 years and an 18x over that same time period if you were to adhere to this 10-month moving average crossover. So I believe that this is something that we all should take into account and pay attention to. Now, there's nothing magical about the 10-month moving average. You can use the 11-month moving average. You can use a 9-month moving average. You could use a 12-month moving average. There's nothing really magical about 10 months. All I'm trying to do here is find a moving average that sets a boundary that kind of defines what the medium-term trend in the market is. Because remember, we could have bullish views even around these market tops here. But if the market is losing that momentum and it's now falling below that moving average, we need to pay attention to that. So even if we have a bullish view, we have to side with the price action. So again, like if you've been following my, my blog, as well as these bi-weekly videos, I have had a bearish view on the market since September of 2022. I still believe even today that the data points to recession in the near term over the next several months here. And I believe an increasing number of leading indicators are pointing to continued difficulty with earnings growth for the S&P 500. But look at the price action here. It's been bullish since early this year. So I believe that we should side with the price action, the primary trend. And one way to define that primary trend is whether the market is trading above or below a medium-term moving average. And, the 10-month moving average is a great way to determine what the medium-term trend is. So as long as this is trading above that 10-month moving average, I would say remain bullish. But the moment this breaks, right, and I believe it will, but the moment it does, that means that it's now aligning with my fundamental views of the market, which is bearish, which is recessionary, which is an earnings recession and an economic recession. So I have a fundamental view. So we should all be spending most of our time doing this step right here. Develop a fundamental view of the direction of earnings and valuation. But we must always respect the primary trend in price. So right now, the primary trend is still bullish. So I would be long the market, but my fundamental view is bearish. And so if this breaks, if that 10-month moving average breaks, it would be time to go defensive. And again, that would be because the market is now aligning with my fundamental view, my pre-existing, pre-held fundamental view of recession. So hopefully you found this helpful, and I think the performance really speaks for itself here. This is a phenomenal risk management tool. Regardless of what your views are, we should be bearish when the market breaks that moving average, and we should be bullish whenever it's trading above or crosses above that moving average. So if you need a copy of these slides, or if you wanted a copy of the spreadsheet, I'd be happy to send this to you. Hopefully you found this helpful here. If you have any questions, again, you can reach out to me. If you are a ZRS client, please send us an email at zrs@zacks.com. And if you are an Advisor Tools client, please send us an email at zat@zacks.com. Thanks, everyone, and talk to you soon in a future webinar.